Howard Marks is probably one of the most successful bond investors of all time. His flagship funds at Oaktree Capital Management have annualised returns on the order of 19% over more than 2 decades. But it's not just bonds he's known for. He's a very astute observer of market bubbles. Marks has been involved in financial markets for almost 50 years, starting out at Citicorp in 1969, and he's been writing his now infamous memos since 1990. As Marks tells it, after writing memos for 10 years without any feedback whatsoever, he then became an overnight success when he released a timely memo in January 2000 entitled Bubble.com. The tech bubble then peaked just 2 months later, with the Nasdaq losing 83% of its value over the next couple of years. And so back on July 26 this year, Howard Marks put out a memo entitled, There They Go Again. That title is an echo of a memo he put out in May 2005 titled There They Go Again, in which he cautioned against real estate prices, hedge funds, private equity, and crude oil. In that case, it took another 2 years for the markets to finally roll over. And so I think it's worth reiterating here that making the observation that asset prices are overextended and prospective returns are low is not the same as saying that you think prices are going down tomorrow, next week, or even next month. Just that it's a good time to proceed with caution. As Marks says in his latest memo, since we never know when risky behaviour will bring on a market correction, I'm going to issue a warning today rather than wait until one is upon us. Now, the entire memo is 23 pages long, so I'm not going to bore you by reading through it from start to finish. You can do that in your own time. I just want to pick out some themes that I found interesting. When it comes to the US stock market, he notes, the S&P 500 is selling at 25 times trailing 12-month earnings compared to a long-term median of 15. The Shiller cyclically adjusted PE ratio stands at almost 30 versus a historic mean of 16. This multiple was exceeded only in 1929 and 2000, both clearly bubbles. While the P and PE ratios is high today, the E has probably been inflated by cost-cutting, stock buybacks and merger and acquisition activity. Thus, today's reported valuations, while high, may actually be understated relative to underlying profits. The Buffett yardstick, total US stock market cap as a percentage of GDP, is immune to company-level accounting issues. It hit a new all-time high last month of around 145 as opposed to a 1970 to 95 norm of about 60 and a 1995 to 2017 median of about 100. Finally, it can be argued that even the normal historic valuations aren't merited, since economic growth may be slower in the coming years than it was in the post-World War II period when those norms were established. And as I've detailed here previously, John Hussman has been tracking those same metrics of market overvaluation and a few others, and clearly we are in a rarefied air at the present time based on a wide range of valuation measures. Now, the final point made by Marks above is that economic growth may be slower in coming years, and this I think is an important point. Despite Trump's proposed pro-growth economic policies, the demographic headwinds are unlikely to result in any kind of economic boom. As John Hussman reminds us, real US GDP growth is driven by two engines, the growth rate of the labour force plus the growth rate of output per worker, or productivity. The Bureau of Labour Statistics projects the US labour force will grow to approximately 164 million by 2024, an increase of not quite 4 million from today, which is just 0.3% per year. This chart and the accompanying explanation from the BLS highlights what's happened to the growth of the US labour force. During the 1970s and 1980s, the labour force grew vigorously as women's labour force participation rates surged and the baby boom generation entered the labour market. However, the dynamic demographic, economic and social forces that once spurred the level, growth and composition of the labour force have changed and are now damping labour force growth. The labour force participation rate of women, which peaked in 1999, has been on a declining trend. In addition, instead of entering the labour force, baby boomers are retiring in large numbers and exiting the workforce. Once again, the baby boom generation has become a generator of change, this time in its retirement. Economic booms begin when unemployment is high and there's a lot of slack in the labour market. And that's hardly the case in the US today with an unemployment rate of 4.3%. As for productivity, that's also been nosediving over recent decades from around 2% in the last half of the 20th century, averaging just 1% over the last decade and closer to 0.5% over the last 5 years. Domestic investment is one way to produce higher productivity, and that's what Trump's tax-advantaged repatriation of corporate earnings abroad is supposed to accomplish. But people have short memories. That's exactly what was tried back in 2004 under George W. Bush, and it accomplished nothing of the sort. In short, it doesn't really matter that Trump has pro-growth policies. The demographics of slow labour force growth and productivity are baked into the cake, and Trump's pre-election promise of 4% real GDP growth is at this point a fantasy. But back to the topic, what does that do for the stock market? Well, it suggests that prices have unrealistic expectations of future economic and thus corporate earnings growth, coupled with record high valuations, and that's a recipe for trouble. Marx also talks about super stocks, the current iteration being the so-called FANG stocks, Facebook, Amazon, Apple, Netflix, and Google, now called Alphabet. But he reminds us this is nothing new. The same was true of the Nifty 50 in the 1960s, oil stocks in the 70s, disk drive companies in the 80s, and tech, media, telecom in the late 90s. But in each of those cases, the environment changed in unforeseen ways. It turned out that the newness of the business model had hidden its flaws, competition arose, excellence in the concept gave rise to weakness in execution, or it was shown that even great fundamentals can become overpriced and thus give way to massive losses. There are clear reasons to be excited about their growth in the near term, but what about the durability of earnings over the long term, where much of the value in a high multiple stock necessarily lies? And that was the point I made in a previous video about Netflix and looking over the valley. Whilst Netflix has great near-term growth prospects, where will it be in 10 or 20 years? Can the price of Netflix stock today be justified by the uncertainty of optimistic long-term earnings assumptions? As Marx says, the super stocks that lead a bull market inevitably become priced for perfection, and in many cases the company's perfection turns out eventually to be either illusory or ephemeral. Some of the can't-lose companies of the Nifty 50 were ultimately crippled by massive changes in their markets, including Kodak, Polaroid, Xerox, Sears, and Simplicity Patent. Do you see many people sewing their own clothes these days? Not only did the perfection that investors had paid for evaporate, but even the successful companies' stock prices reverted to more normal valuation multiples, resulting in subpar equity returns. The powerful multiple expansion that makes a small number of stocks the leaders in a bull market is often reversed in the correction that follows, saddling them with the biggest losses. But when the mood is positive and things are going well, the likelihood of such a development is easily overlooked. And that's exactly what happened to the leaders during the tech bubble that I talked about in a previous video. Back in 2000, market darlings Cisco, Intel, Oracle, and Microsoft were all profitable companies. All had PE ratios in excess of 100 times earnings, and all subsequently toppled between 65 and 90% by the end of the tech wreck. Microsoft made 85 cents a share in 2000. This year they're expected to make $3 a share, and yet the stock price is only 70% higher than it was 17.5 years ago. That's an average annual return of about 4%, not including dividends. Oracle's annual return since its high in 2000 has been about 1% annually, excluding dividends, and Intel and Cisco are still way below where they were in 2000. Now again, I'm not suggesting that Netflix is going to be a repeat of Cisco or Microsoft, but it's worth bearing in mind what you pay for stock today and how much of future expectations is already built in. Marx concludes the part on equities by stating, "I'm not saying the FANGs aren't great or that they'll suffer such a fate, just that their elevated status today is a sign of the kind of investor optimism for which we must be on the lookout." Marx then goes on to talk about ETFs, credit markets, emerging markets, private equity and cryptocurrencies, which is all well worth a read. And he concludes by saying, "I'm absolutely not saying that stocks are too high, that FANGs will falter, credit investment is risky, digital currencies are sure to end up worthless, or private equity commitments won't pay off. All I'm saying is that for all the things listed above to simultaneously be gaining in popularity and attracting so much capital, credulousness has to be high and risk aversion has to be low. It's not that these things are doomed, just that their returns may not fully justify their risk. And more importantly, that they show the temperature of today's market to be elevated, not a nonsensical bubble, just high and therefore risky." So again, Howard Marks is not saying sell, 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 but rather that now is a time for caution. Now, whilst I avoid making predictions about short-term market movements, I would note that there's been some deterioration in market internals. As John Hussman continually reminds us, The most unfavourable market conditions occur when extreme overvaluation is joined by deteriorating internals. The percentage of stocks now below their 200-day moving average surpassed 50% on Friday. That's not a sign of an imminent collapse. The market can and has recovered from similar points in the past. It's just a data point I thought was worth noting. So what do you do with all this information? Well, that's up to you, and although it's cliche to say, it depends on your own personal circumstances. I'm not going to tell you what you should do. I prefer to tell you what I'm doing. So last Thursday, I initiated some short positions on the S&P 500, the Nasdaq 100, and Tesla. And I'm fairly risk averse, so these positions are very small. And thankfully, those positions have moved in the right direction on Thursday and Friday. That's not to say that I have strong convictions about a continued decline. Markets can and often do turn on a dime, and that's why I have reasonably tight stops on those positions. So in summary, I agree with Howard Marks' cautionary tone, and I encourage you to read the full memo. It's full of very insightful observations from one of the best investors in the business. So, is it time to exercise some caution, as Howard Marks suggests, or should we throw that caution to the wind? Let me know your thoughts in the comments below. I'll see you next time.